Imagine this. A company that literally invented 3D printing, the tech. That sounds like it's straight from the future. But somehow its stock has just tanked. We're talking billions down to, well, mere millions. So the big question is, can this innovator stage a comeback? Or is it just a classic value trap waiting to catch investors? We're diving deep into 3D Systems Corporation today, ticker DDD. Its future really seems to hang on a pretty high-stakes gamble. And hey, for those of you tracking DDD closely, just know we'll be covering their earnings within minutes of release. So stay tuned and subscribe for that immediate analysis.
That's right. Today we're pulling all the data we have, articles, research, our own insights, basically giving you a shortcut to really get a handle on 3D systems, especially after their recent mixed earnings report back on August 11th, 2025. The stock closed that day at $1.76, and all our analysis today is based on data as of August 12th, 2025. We want to give you the full picture.
Okay, and to make this as clear as possible, we've split this deep dive into two main parts. Part one is all about the business, the management, and the financials, the fundamentals.
And then in part two, we'll get into market sentiment, who actually owns the stock, the risks involved, and wrap it all up with our conclusion.
Sounds good. Okay, let's unpack this. Chapter 1, Business Understanding, Pioneering the Future or Burning Through the Past. That kind of sums it up, doesn't it? Can 3D Systems' big pivot into things like regenerative medicine and aerospace finally deliver on that decades-old promise? Or is it just, well, a value trap? That's really the core question for 3D Systems Corporation, NYSE, DDD.
It really is. And it's important to remember this is a foundational company in additive manufacturing. As you said, our analysis is anchored to August 12th, 2025, with that $1.76 closing price from the day before.
So, fundamentally, how do they actually make money? What's their model?
Well, at its core, it's often called a razor and blades strategy, like selling a printer cheap but making money on the ink. They sell a pretty extensive portfolio of 3D printers. Those are their razors for both plastics and metals.
Okay, the hardware.
Right. But then the crucial recurring revenue comes from the blades, their consumable materials. They've got over 130 proprietary materials. And the business itself is split into two main segments: healthcare solutions and industrial solutions.
So it's more than just selling the big machines. What does that whole ecosystem look like for a customer?
Yeah, it's built around three core revenue streams. First, obviously, is the one-time hardware sales of those printers. Second, and really critical for them, is consumable materials. We're talking advanced plastics, nylons, various metals, even specialized biocompatible stuff for medical uses. And this revenue is directly tied to how much people actually use the printers they bought.
Makes sense. The more you print, the more material you buy.
Exactly. And the third stream is software and services. This includes licensing for their workflow software like 3D Expert for metal printing and Octon, which is their newer AI-powered manufacturing system. Plus, maintenance contracts, on-demand parts manufacturing, consulting. It's meant to be an end-to-end solution.
That sounds incredibly comprehensive, almost futuristic in parts, especially the healthcare side. But then you look at their market position today. This company was founded back in '86 by Chuck Hull, the guy who invented stereolithography.
Right, the foundational tech.
And now it's a microcap, around $240 million market cap. That's just a massive drop from its peak, wasn't it? Over $9.5 billion back in 2013.
It's a staggering fall. It really shows how tough it is to stay on top in a tech sector that evolves so quickly.
So how do they go from being a titan to, well, this?
It's a stark contrast, isn't it? They've really struggled against competitors, both established ones and nimble new players. They've shrunk significantly in market value. Their basic value proposition is still there, helping companies innovate faster, make complex parts, especially in healthcare and aerospace, where precision is key. But the market just isn't valuing that heritage or vision much right now.
So the company itself had shrunk. But what about the overall 3D printing industry? Is that market still growing?
Oh, absolutely. The broader industry is definitely still expanding, and it's maturing, too. It's moving beyond just making prototypes to actually producing end-use parts. That's a huge shift. Forecasts are pretty robust, predicting the market could hit, somewhere between $35 billion and maybe even over $130 billion by the early 2030s. That implies pretty strong growth rates, maybe 17% to 24% CAGR.
What's driving that growth, then?
A few things. Government and R&D investments are big. Plus, there's rising demand for customization, think patient-specific implants in healthcare. And the technology keeps getting better, faster speeds, more materials available.
Okay, so the market's growing, but who are 3D Systems actually competing against now? It sounds crowded.
It is intensely competitive. You've got the other legacy players like Stratasys. You've got industrial giants like HP and GE Additive who've moved in, and then lots of agile startups focusing on specific niches like desktop metal. Competition isn't just about having the best tech anymore. It's also about business models. Are you an open system or a closed proprietary one? And specializing deeply, all this competition is putting downward pressure on the hardware prices, which forces companies like 3D Systems to focus more on the whole package materials, software services, not just the machine itself.
And you mentioned their focus on healthcare, especially things like implants. That was bringing a whole layer of regulatory complexity, right?
Absolutely critical factor, especially in their target growth areas.
Hmm.
The US FDA, for instance, heavily regulates medical devices. You need strict adherence to processes, quality control, validation. It's complex and expensive. Then you have developing industry standards from bodies like ISO and ASTM. Even environmental agencies are starting to look at emissions from the printing process. Plus, for industrial uses like aerospace, you need specific certifications like AS9100. It's non-negotiable. A big challenge for the whole industry, honestly, is the lack of universal harmonized standards. That can slow things down.
Given all the history, the competition, the regulations, what would you say are 3D Systems' real competitive advantages now? What's their moat, if they even have one?
Yeah, it's a bit of a mixed bag. Their brand strength and recognition, historically unparalleled. They commercialized the first printer, created the standard STL file format, but frankly, the value of that legacy is diminishing as their financial and tech leadership has waned.
What about cost advantages, economies of scale?
Doesn't seem like it. Those persistent negative operating margins and the ongoing restructuring suggest inefficiencies, not scale advantages. They're actively shrinking their footprint to try and align costs.
Okay, how about network effects or switching costs? Is it hard for customers to leave them?
There are moderate switching costs, particularly in those regulated industries like medical devices. Once a customer validates a specific 3D Systems printer and material for, say, an FDA-approved implant, the cost and hassle of switching to a competitor and revalidating everything is significant. That creates stickiness. But the long-term threat here is the industry trend towards more open materials and open architecture systems, which could erode that lock-in over time.
So what are their truly unique strengths then?
I'd say their strongest unique assets are their deep expertise in established processes in healthcare. Things like virtual surgical planning, VSP, patient-specific guides and implants, and their push into regenerative medicine. That's a high-value, potentially defensible niche where experience really counts. They also have an extensive intellectual property portfolio. They mentioned getting 45-plus new patents just in the last decade.
So boiling it down, their big bet, their strategic pivot, is really doubling down on medical tech and aerospace and defense.
Exactly. These are sectors with high barriers to entry, where regulation and validation matter immensely. They're betting that their decades of experience and validated processes give them a sustainable edge there. They're trying to shift the competition away from just price on hardware towards these specialized, high-value applications where they hope they can command better profit margins. It's a high-stakes bet, no doubt about it.
Chapter 2, Management Evaluation. Okay, so with a company facing these massive challenges, leadership is absolutely critical. Dr. Jeffrey Graves came in as CEO back in May 2020. What's the assessment of his tenure and the current team's response?
Well, the current team, definitely led by Dr. Graves, has been operating in full-on crisis management mode. Their track record since 2020 is really defined by trying to stabilize the ship. They've launched a very aggressive cost reduction program targeting over $85 million in annualized savings by mid-2026. That involves workforce restructuring, consolidating facilities globally. They're tackling the financial challenges head-on. The focus is stabilization and streamlining.
Are they being transparent about these difficulties? How's communication with the market?
They've actually been notably transparent, I'd say. They talk openly about the headwinds, weak customer capital spending, the macroeconomic environment, even the direct hit from tariffs. That kind of candor is important when you're trying to rebuild investor confidence. Ethically, they have frameworks like a code of conduct, but it's worth noting there has been a class action lawsuit, which is, a potential blemish.
Now, capital allocation.
Yeah.
This seems to have been a real problem area for them historically, right?
Yeah.
All those acquisitions.
A massive issue historically. You mentioned it back in the 2000s and early 2010s. It was growth by acquisition, almost scattershot. They bought nearly 50 companies. It created a complex, inefficient organization. But under Dr. Graves, a complete 180. The focus now is disciplined core operations. They've made strategic divestitures of non-core assets like Symbionics for $305 million and Geomagic for $123 million.
Right, bringing in cash.
Exactly. Bolstered the balance sheet significantly. And now the capital that is being spent is directed internally mainly towards R&D in those high potential areas we discussed, like regenerative medicine and advanced materials. It's a much more focused approach.
What about returning cash to shareholders? Dividends, buybacks?
They've never paid a dividend, and no systematic buyback programs either, which makes sense given their need to preserve capital, especially recently. However, there was that interesting move in June 2025. They did a strategic, privately negotiated share repurchase, bought back about 8 million shares, roughly 6% of the total outstanding. But that was part of a larger debt restructuring deal.
Ah, okay. Let's talk about that recapitalization in June 2025. It sounded pretty significant. What drove that?
It was basically driven by necessity. They had a big chunk of convertible debt coming due in 2026, which was a major overhang. Facing that maturity, they issued new secured notes due further out in 2030, but at a higher interest rate. They used the money from the new notes, plus cash on hand, to retire a big portion of those looming 2026 notes, actually at a discount to face value. At the same time, as part of the deal, they repurchased those shares at $1.87 each. The new 2030 notes also have a conversion price around $2.24.
So what does that whole maneuver signal?
It was a complex and definitely costly way to push out their debt maturity. You could see it as a vote of confidence, perhaps, from management and the institutions involved, signaling they believe the company will survive and is worth more than its recent trading range. Essentially, they swapped near-term bankruptcy risk for longer-term, more expensive debt. It bought them time.
But the ultimate measure of how well management uses capital is return on invested capital, ROIC. How does that look?
Exceptionally poor. Just awful, really. For the trailing 12 months, it's deeply negative, minus 14.16%. And this isn't just a recent blip. It's a consistent long-term pattern of destroying shareholder value through their investments. This metric really highlights why the current restructuring and the shift in capital allocation strategy are so desperately needed.
Chapter 3, Financial Analysis. All right, let's dive into the hard numbers. Chapter 3. Financial analysis. As of August 12, 2025, 3D Systems is a microcap, market cap around $240 million. You mentioned that stunning drop from over $9.5 billion peak in late 2013. How's the revenue trend looked over the last 5 years or so?
It's been a pretty concerning picture, honestly. After a brief rebound in 2021, the trend has been consistently downward. We saw revenue go from about $557 million in 2020 up to $615 million in 2021, but then down to $538 million in 2022, $488 million in 2023, $440 million in 2024, and the trailing 12 months ending Q2 2025 are around $431.8 million. So yeah, persistent revenue erosion is really the central challenge here.
Well, that's a steady decline. And profitability, are they making any money on those sales?
No, they're deeply unprofitable across the board. Their trailing 12-month gross margin is around 36%, which isn't terrible in itself, but it falls apart after that. Operating margin is way down at minus 30% TTM. For Q2 2025 specifically, they had a $15.4 million operating loss on about $95 million in revenue. And net margin, even worse, around minus 64% TTM. It's crucial to remember they reported a large GAAP net income in Q2 2025, about $104 million. But that was purely an accounting gain from extinguishing that old debt we talked about. It wasn't from profitable operations.
Okay, so the bottom line is still deeply red from actually running the business. What about cash flow? Are they generating cash or burning through it?
They are predominantly burning cash. Free cash flow has been highly volatile over the past 5 years, but mostly negative. We saw negative $32 million in 2020, then that big positive outlier of $451 million in 2021, which was heavily driven by financing activities and those divestitures, not core operations. Then it was negative $91 million in 2022, negative $108 million in 2023, negative $61 million in 2024. This is a major concern. It means they have to rely on their cash reserves or external financing just to keep the lights on.
So putting it together for financial stability.
Yeah.
It sounds like consistent, deep losses. What about their debt load? You mentioned the recapitalization. How does the debt-to-equity ratio look?
It's high, very high, actually, around 144% or 1.44. And that's deteriorated significantly from just 9.6% 5 years prior. It clearly shows their growing reliance on debt, which increases financial risk. Their total stockholders' equity has also plummeted from over $800 million in 2021 down to about $148 million by the end of 2024. This balance sheet crisis really provides the context for why that June 2025 recapitalization was, as I said, a defensive necessity. It makes the stock highly speculative.
Despite all that debt and cash burn, you mentioned their current ratio is healthy at 2.79. What does that tell us? Why is that metric okay when others are so bad?
Right, that's one brighter spot on the balance sheet, at least in the short term. A current ratio of 2.79 indicates they have almost 3 times the current assets, like cash, receivables, inventory, needed to cover their current liabilities, like accounts payable, short-term debt. It suggests strong near-term liquidity. It means they have a buffer to meet their immediate obligations and fund the ongoing restructuring without facing an imminent cash crunch. It buys them time, essentially. But it doesn't solve the underlying profitability or long-term debt issues.
Okay, that makes sense. Now, valuation. With negative earnings, the standard price-to-earnings PE ratio is useless. What about price-to-sales, PS?
Exactly. PE is not meaningful here. Their price-to-sales ratio is currently around 0.56. That's quite low. It reflects the deep pessimism in the market. It basically means investors are only willing to pay about 56 cents for every dollar of 3D Systems annual sales, signaling very little confidence in future profitability or growth from those sales.
So if we were to attempt an intrinsic valuation, say using a discounted cash flow DCF model, how reliable or speculative would that be, given everything we've discussed?
Extremely speculative. A DCF relies on forecasting future free cash flows, and as we just saw, 3D Systems has consistently negative free cash flow. So any DCF model becomes highly sensitive to the assumptions you make about if and when they can turn that around. For an educational model, you'd have to plug in assumptions like continued negative FCF in the near term, then a gradual transition to positive SCF as cost cuts hopefully take hold and revenue stabilizes, followed by maybe modest medium-term growth driven by those healthcare and aerospace segments. Crucially, you'd need to use a very high discount rate, maybe 12% to 15% WACC, to reflect the significant risks involved. Their stock is very volatile, with a beta around 1.93, almost twice as volatile as the market. Plugging in those kinds of assumptions, you might get an estimated intrinsic value in a pretty wide range, maybe $1.50 to $2.50 per share. That wide range itself tells you how uncertain the outcome is and how dependent the value is on the turnaround actually succeeding.
Chapter 4, Market Sentiment. Right, that makes the valuation tricky. Let's move to part 2 and start with Chapter 4, Market Sentiment. We've looked at the business, management, financials. What does the market think? What's the overall feeling about DDD?
Well, looking at Wall Street analysts, the prevailing sentiment is definitely cautious, maybe even neutral. The consensus rating is a firm hold. Analysts aren't exactly pounding the table to buy it, but they're not screaming sell either. It's very much a wait-and-see stance.
Okay, a hold. What about their price targets? Where do they see the stock going in the next year?
The average 12-month price target falls somewhere between $2.72 and $3.50. Now, compared to the current price of $1.70, that does suggest significant potential upside if they're right. However, the range of those individual analyst targets is really wide, from as low as $2 to as high as $4.20. That wide dispersion just screams high uncertainty and disagreement among the analysts themselves.
How is the general media coverage, and how has the stock reacted to recent news, like earnings?
It's been mixed, but probably leans more bearish overall. The news consistently highlights the fundamental problems, the missed revenue targets, the ongoing losses, the tough macro environment they blame for weak sales. Positive news tends to focus more on specific strategic things, like partnerships. They have one with United Therapeutics in regenerative medicine that gets mentioned, or progress on the cost-cutting plan, or wins in niche areas like aerospace and defense. But the market reaction tells a story, too. The stock took significant hits after both the Q4 2024 and Q1 2025 earnings reports came out, which clearly indicates the market was disappointed.
Okay, let's talk market indicators. Short interest is often a big tell. What's that looking like for DDD?
It is exceptionally high, really stands out. Approximately 20% of the company's float, the shares available for public trading, is sold short. That's about 26.23 million shares. That signifies a very strong, deeply entrenched, bearish sentiment. A large chunk of the market is actively betting that the stock price is going to fall further.
Wow, 20% is huge. Does that create potential for a short squeeze if things turn around unexpectedly?
Absolutely. It's a classic setup, potentially. While high short interest shows deep skepticism, it also means there's a lot of fuel for a potential short squeeze. If some genuinely surprising positive news were to hit maybe a breakthrough in regenerative medicine or much faster than expected profitability, it could force those short sellers to rush to buy back shares to cover their positions. That sudden concentrated buying pressure could cause the stock price to spike dramatically and rapidly. It adds another layer of volatility.
Looking at the technicals briefly, where is the price relative to its moving averages?
Right now, the stock, $1.76, is trading just slightly above its 50-day moving average, around $1.67. That might hint at some potential stabilization in the short to medium term, maybe finding a bottom. but it's trading significantly below its 200-day moving average, around $2.66. That's generally seen as a strong technical signal of a persistent long-term downtrend still being in place.
So pulling all that market sentiment together, what's the overall message the market is sending about 3D systems right now?
The overwhelming message is show me, prove it. Analysts are hesitant, sitting on the fence. You have a very large number of investors actively betting against the stock via short selling. The collective message is one of depth skepticism. Investors are basically waiting for tangible, sustained proof that the turnaround is real. That means seeing a return to consistent top-line growth and, crucially, a clear, believable path back to generating positive free cash flow. Until then, caution reigns.
Chapter 5. Ownership structure.
Right.
Okay, let's look at who actually owns DDD stock. Chapter 5. Ownership structure. What does the breakdown tell us about investor conviction?
Well, institutional investors hold a pretty significant stake, but it's not a controlling majority, somewhere around 46% to 47% of the outstanding shares. What's interesting, though, is who those institutions are. It's dominated by the huge passive asset management firms. BlackRock holds over 10 million shares. The Vanguard Group has over 7 million. State Street has 6 million.
So mostly index funds.
Largely, yes. Their ownership is often driven simply by DDD being included in various market indices they track, rather than representing an active, high-conviction bet on the company's turnaround. It's just a big chunk of that institutional ownership is passive money just following the market.
What about the insiders? Are the executives, the directors, putting their own money where their mouth is?
Insider holdings are relatively low, actually, around 4% or so. Looking at recent transactions, they mostly consist of acquisitions related to their equity-based compensation plans, stock awards, options exercises, that sort of thing. What you don't see is significant open market buying with their own cash. However, maybe a mildly positive signal is the absence of significant open market selling by executives or directors recently. They aren't dumping shares, which might suggest some level of confidence or at least patience.
Is the ownership concentrated in a few hands, or is it fairly spread out?
It's relatively diffuse. There's no single individual or entity holding a controlling interest. Even the top 10 institutional holders, while significant collectively, don't individually wield undue influence. So the implication of this ownership structure, lots of passive funds, relatively low insider stakes, no major activist investor shaking things up, is that there's a lack of strong, concentrated conviction from what you might call smart money. It seems like the active, high-conviction investors are mostly watching from the sidelines, waiting for more concrete evidence of recovery before committing serious capital.
Chapter 6. Risk assessment. All right, let's explicitly talk risks. Chapter 6. Risk assessment. A SWOT analysis is always a good framework. What are the key strengths, weaknesses, opportunities, and threats for 3D systems?
Okay, starting with strengths. You've got that pioneering brand history, though its value is debatable now. A strong IP portfolio is definitely a plus, and that deep expertise, particularly in the complex healthcare applications, is a real asset. They also have a very comprehensive product portfolio covering hardware, software, and materials.
And the weaknesses. We've touched on many already.
Yes, the weaknesses are significant and hard to ignore. The chronic unprofitability, the negative free cash flow burn, that high and increasing debt-to-equity ratio, the multi-year revenue decline we saw. There's also a potential risk of falling behind technologically compared to competitors, and maybe some vulnerability from their reliance on a somewhat closed proprietary ecosystem in an industry trending towards openness.
Okay, what about opportunities? Where's the potential upside beyond just fixing the weaknesses?
The opportunities are certainly there. The overall global 3D printing market is large and growing, as we discussed, with forecasts suggesting 17% plus annual growth. There's huge potential in expanding into those transformative high-value applications like regenerative medicine and bioprinting. That's the lottery ticket. Also, the growing adoption of 3D printing for actual end-use parts, especially in aerospace and defense and automotive, is a major trend they could benefit from, and maybe some tailwind from companies looking to localize supply chains using additive manufacturing.
And finally, the threats. What external factors could derail them?
The threats are very real. Intense competition is number one from larger, better capitalized rivals and those nimble startups. Significant macroeconomic headwinds are a major issue right now, especially high interest rates suppressing customer capital spending. Geopolitical factors like trade tensions and tariffs add costs. And in any tech field, there's the constant risk of technological obsolescence if you don't keep innovating faster than the competition.
Let's dig into those macro factors a bit more. How exactly are things like inflation and interest rates hitting 3D systems?
They have a direct negative impact, and management has been pretty clear about this. High interest rates make it more expensive for their customers to finance big capital equipment purchases, like high-end 3D printers. So customer capital expenditure gets suppressed, leading to lower hardware sales for DDD. Plus, general inflationary pressures squeeze their already thin or negative profit margins by increasing costs for materials, energy, labor. And as an unprofitable company burning cash, higher rates also increase 3D Systems' own cost of capital if they need to borrow more. It really makes them behave much like a traditional macro-cyclical industrial business, sensitive to the economic cycle despite being in the tech sector.
And you mentioned tariffs. What about the specific impact of those U.S. imposed tariffs from 2025?
Yeah, that's a direct, quantifiable hit. Management explicitly stated that tariffs increased their costs by about $1 million in Q2 2025 alone. These tariffs raise the cost of imported electronic components and potentially some raw materials that go into their printers and materials. While some might argue tariffs could eventually incentivize customers to reshore manufacturing using 3D printing, the immediate direct impact on 3D Systems' bottom line is clearly negative. It just adds another cost pressure they have to deal with.
Chapter 7. Conclusion. Okay, we have covered a lot of ground. Let's bring it all together in Chapter 7. Conclusion. Synthesizing all these findings, what's the bottom line? What's the bull case versus the bear case for 3D Systems today?
It really boils down to a starkly divided investment case. 3D Systems is undeniably at a critical inflection point.
Let's start with the bull case. What's the argument for why someone might invest, despite all the challenges?
The bullish argument hinges on the potential for a successful operational turnaround. They are taking aggressive steps, the cost-cutting, the strategic divestitures, fortifying the balance sheet through that recapitalization. The fact they beat EPS estimates in Q2 2025, mainly due to cost controls, offers a glimmer of hope that management can execute. The strategic pivot towards those high-margin, high-barrier-to-entry sectors, healthcare and aerospace and defense, is strategically sound and plays to their strengths. The stock is trading at a very low price-to-sales multiple, around 0.5, suggesting if they can turn things around, there could be significant potential for the market to re-rate the stock much higher. And then there's that long-term, potentially transformative upside from their work in regenerative medicine, the lottery ticket aspect.
Okay, that's the optimistic view. Now, hit us with the bear case. Why should investors remain skeptical or stay away?
The bear case is grounded in the severe and persistent financial distress. We're talking chronic unprofitability, negative free cash flow, a deteriorating balance sheet with high debt. That secular revenue decline is worrying, and there's no clear, immediate catalyst visible for robust top-line growth to resume, especially with the tough macro environment acting as a headwind. The competitive landscape is brutal, with larger and potentially better-funded competitors, and that overwhelmingly negative market sentiment, reflected in the extremely high short interest, shows just how deep the skepticism runs. The high debt load and the continued cash burn create a very tangible risk of further financial trouble or shareholder dilution down the road if the turnaround falters or takes too long.
So bringing it back to valuation, what's the summary takeaway?
Based on our educational discounted cash flow model, which, again, is highly speculative and sensitive to assumptions about the turnaround, we landed on a potential intrinsic value range of roughly $1.50 to $2.50 per share.
And with the stock currently trading at $1.76 as of August 12th, what's the concluding outlook?
It appears that 3D Systems Corporation is currently trading right within that estimated intrinsic value range. The market price seems to be reflecting or balancing the significant execution risks, the company's troubled financial history, and the intense competitive pressures against the potential for a successful turnaround and the allure of its long-term technological promise. It really positions DDD as a high-risk, potentially high-reward turnaround play. It's definitely not suitable for conservative investors. It's more for those with a very high tolerance for risk, a long investment horizon, and a strong belief in management's ability to execute the strategic pivot into those specialized high-margin sectors.
That makes sense. Here's a final thought to leave everyone with. Beyond just the dollars and cents, the quarterly numbers. What if the true long-term value of a company like 3D Systems isn't just about regaining market share today, but about its potential to actually enable entirely new industries? Things like personalized 3D printed organs, or factories printing complex aerospace components on demand right where they're needed. Could that fundamentally reshape manufacturing and healthcare in ways we're only just beginning to grasp? Something to ponder. If you found this deep dive insightful, please do remember to like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. Also, our members, for $9.99 a month, get priority requests for deep dives on tickers they're interested in. And over the next few months, we're planning to cover all of the S&P 500 stocks, with members getting exclusive priority access to those analyses.
And if you just want a one-off deep dive on a specific stock that's caught your eye, you can always drop us a super thanks on the video. We appreciate the support.
Finally, the important reminder. This analysis was generated by an AI system using the data provided and is intended for educational purposes only. It should absolutely not be considered financial advice. Always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.